Good evening, everyone. That was quite an insightful keynote speech. What I'm going to do next is take a bit of a tangent. I'm going to show you some relevant charts related to some of the most liquid futures globally. And I'm going to try to offer you some insights on what these charts are telling us, but also what I'm going to show you is how you can leverage off the capabilities of the Bloomberg terminal to offer actionable insights in your trading and investing activities. So before I start off, I'd like to thank my colleague Kevin, who's up there somewhere and who's going to help me with the Bloomberg screens. So firstly, I just wanted to touch upon something called Market Live. Now, Market Live is part of Bloomberg's First Word news service. And what that is that it is a real-time editorial insight that is offered in a blog-style, bullet points, often accompanied with very powerful charts, which can really offer pretty cool insights into what's happening globally across assets, across regions. And I just wanted to pull up one chart just to show you how this can be of great help in trading activity. And this chart is a chart of the net bullish bets on crude oil. And you can see that there's been a sharp decline over the last couple of months in the net bullish bets. And the idea here is that if you look at the top left corner of the screen, you notice that there is an index on Bloomberg, a ticker on Bloomberg, that actually captures this particular piece of data and offers a historic time series on this particular series of data. And we have thousands and thousands of such indices, such tickers, that capture economic data, macroeconomic data, key indicators across assets, volatility, and so on and so forth, that can really offer ideas graphically often and visually to assist in your trading activities. So moving on to the next chart, this is, of course, one of the most popular in liquid futures globally, listed on the CME, the S&P 500 E-mini Futures. Now, obviously, we noticed that there was a sharp crash in February, and since then, there's been both sides of news flow, good and bad, and the markets have remained range-bound. Now, there's numerous ways to look at this chart, of course, fundamentally and technically, statistically. But what I want to show you is how you can overlay several studies, several technical studies or indicators on charts within a few clicks in Bloomberg. Now, we currently offer over 300 such studies, but the one I've pulled up here is called the Bollinger Bands, which I'm sure many of you are familiar with. And what this study does is something extremely elegant and simple. It shows you a moving average of whatever the future or the asset you're plotting, and in this case, I've selected the 20-day moving average. And then it shows you two bands. The upper band is 2 standard deviations above the moving average, and the lower band is 2 standard deviations below that moving average. All of this is completely customizable. And you notice that despite being such a simple and elegant study, it really tends to capture the highs and lows pretty well. And it does seem to suggest that the market is about 2 standard deviations above its moving average right now. Now, what happens next? Who knows, But this does seem to offer a very powerful optical idea or optical view into what the price action of that security has been. And the reason I say this is very relevant is whether it's humans or algorithms trading these futures, what they're all looking for is a divergence from the momentum, a divergence from the long-term average, a divergence from the mean. It's just different sophisticated ways of looking at divergence. And this, fundamentally, standard deviations and means are what captures that in the simplest of manners. So the next chart, please, Kevin, is the Nasdaq-100 Futures. And in this case, what I want to highlight is, if you look at the top left corner, the ticker is the NQ1 index. Now, what we've done on Bloomberg is that we realized that most futures are only active for the front month, either the monthly expiry or the quarterly triple witching expiry. And so what you notice is that those futures really trade only for that month or those 3 months. So what we've done on Bloomberg is we've created generic tickers, such as the NQ1, and that means this is the generic first expiry of the Nasdaq, which means you can then have the data series for a much longer period of time, often decades, if not years and years. And this, again, is the Nasdaq generic ticker plotted using a candlestick chart, not just the line chart, but a candlestick chart, which often gives you more insights into the highs and lows and gaps, which can be quite relevant for many of you. And this, again, is the Bollinger Bands plotted on the Nasdaq futures. Once again, the Nasdaq has obviously outperformed most global equity indices, naturally because of the technology stocks which continue to outperform. If you ask me what that really tells us, I would say fundamentally that's telling us that as a species now, we're valuing our virtual lives, our digital identities more than our real lives. But of course, that's open to interpretation. But this, despite the fact that this has been one of the most outperforming indices, the technical charts also suggest that this is about 2 standard deviations above its moving average, although there has been a slight retracement having hit that divergence. The next chart is, again, one of the most popular futures these days, and these are the currency futures, in this case, the euro-dollar future. The reasons for the popularity of these futures are obvious. They offer leverage. They offer a very high amount of liquidity. And it's often only very, very sophisticated institutions that can actually trade the spot currency. And so these futures offer access to a lot of other investors. Now, you notice that on this chart, what we've done is that we have a little button right at the top of the charts, which lets you select the key events for any given security. And by clicking on that little button, these little indicators come up, which highlight what are the key events that have caused a particular price action, a correction or a rally or whatever it was. And you can hover your mouse on any of those key events on that particular future or that particular asset, and you get a little summary of what really happened. Was it an economic data? Was it some other kind of news release? Was it the exchange? Was it the commercial bank's rate decisions, etc.? And there's also another button, the news button. And if you click on that button and hold your mouse at any point on that security, you get a little pop-up which explains what were the key news, what were the most read or most clicked news items that led to that price action. And in this case, of course, it's the euro-dollar future that we're looking at. And obviously, this was the Italian elections and the uncertainty around those elections and the coalition government that led to that sharp price action. So these are the 2 things that I wanted to highlight, the key events and the news, which really offers a way to investors to leverage the power of the entire Bloomberg offering, including the news, on any given security. The next chart, please, Kevin, is the 10-year Treasury Futures. As most of you are quite well aware, the 10-year bonds have been selling off quite aggressively, which is obviously reflected in the future. This has led to something very interesting, which is that the 10-year yield has hit a 7-year high recently. We hit about 3.2%. We're still hovering at about 3%. But the idea that I want to emphasize here is that often these futures or these securities are not traded or too relevant in isolation. Investors often want to look at them in relative value, in comparison to another security. And the next chart that I've pulled up is a function on Bloomberg called HS, historic spread. And I've created a spread here of 2 commodities, or 2 futures rather. One is the 10-year Treasury, and the other is the 2-year Treasury, which are often traded correspondingly, which are often traded as a pair. And what we have on the right-hand panel is actually a statistical analysis of the spread between these 2. Now, you notice that the spread currently trades very close to the mean. It's in the 63rd percentile, not too far from the mean and the median, for that matter. But you notice that there have often been divergences, and these divergences are what can be played very easily by futures traders as a pair trade. The next example is similar. I've pulled up the example of the silver futures that trade on the COMEX. Now, silver is one of the commodities that has held pretty steady in recent times. But if I now run a historic spread of futures on silver versus the futures on gold, then we notice something interesting. We notice that the spread or the relationship between these 2 futures has offered some very interesting trading opportunities in the recent past. We notice that gold has been selling off. The orange line, which represents the gold future, has been selling off due to many reasons. The most prominent reason is probably the rise in yields, which makes gold less attractive versus bonds. But silver has held steady. And so looking at that relationship statistically and historically in this manner can offer actionable insights in trading these different futures. The next one is very interesting, very topical. This is the Volatility Futures. And the first chart that I've pulled up is the VIX futures. Now, this obviously gives us a very, very solid barometer of market risk and market sentiment. And of course, in Feb, there was a very sharp and dramatic rise in the VIX, in the volatility, due to the sell-off in the markets. This has started correcting, but we're still far away from the lows that we saw last summer. We're still a good 5 or 6 or 7 volatility points away from the lows of last summer. The next chart is a regression analysis on the volatility across the Atlantic. So I've pulled up the volatility future for the VIX in the United States versus the volatility represented by the VSTOXX, or the VSTOXX future, which represents the volatility in Europe. And you notice on the right-hand panel that they have a very high correlation. The R is about 82, right? So they are highly correlated. But yet, if you look at the dispersion plot and the regression line, there are points that are significantly deviated from the regression line. And these are the points where volatility across the Atlantic has diverged significantly, statistically speaking. And the futures on these volatilities offer investors a very easy way to exploit that divergence, buying one future versus selling others based on this kind of technical analysis. The next chart is, again, extremely relevant for futures traders. What this chart does is that this is a function on Bloomberg called CCRV, or curve analysis. Now, what this tells investors is that it shows you the term structure of a future. So any given asset would have futures for different expiries, 1 month, 3 months, 6 months, 18 months, so on and so forth. And the relationship of the price across those different terms offers investors a very good idea of what market sentiment is. Now, these are the different time stamps, or these are the term structures of the VIX future at different times across the last 5 or 6 months. And you notice that at some times the curve is very steep, in which case the short-term volatility is low. But at some times the curve is very flat, in which case the short-term volatility or market risk sentiment is very high. But if I now just run that chart, including a curve for the sell-off in February, then you notice the white line is inverted. The futures actually went into what is called a contango, which means that the short-term future went significantly above the mid and the long-term ones. Or in other words, in this case, the short-term volatility was being priced significantly above the mid or the long-term volatility. But that curve immediately reverted back to the normal term structure, as you can see from the other lines. And that again, and this chart therefore again offers investors a very good way to analyze the market sentiment for a future based on the price of the future across different expiries. So lastly, the very notorious chart of the Bitcoin futures. Now, you notice there is a big gap. Now, why traders really like the candlestick charts is that you can look at the gaps. For an asset that's as volatile as a cryptocurrency, looking at gaps becomes very relevant from a technical perspective. But what I really wanted to show with this chart is that on Bloomberg, we not only have the price of any future or any asset for that matter, but we also have a lot of second-order data, such as the historic volatility of that asset. So if I run the next chart, which is a function called HVG, Historic Volatility Graph, then this is capturing the actual volatility of the Bitcoin dollar currency pair. And this is something very important for futures traders, because when you are entering a future, you want to know what is the volatility of that underlying asset. And despite all the news flow and all these sharp moves, we noticed that the volatility of Bitcoin has actually come off in recent months. It was actually very, very highly volatile as far back as June 2016, but that volatility has actually significantly come off. So that's my talk there. I'm going to be hanging around after this session, and I look forward to interacting with some of you. We have several other functions for those who are interested. Futures calculators, which can help you generate the fair value of a future based on your own inputs. Options monitors, which also offer insights into the options market connected to the future or any other underlying. And so I look forward to interacting with some of you at the end of this talk. Thank you very much.